Greetings everybody and welcome to class, and in this video we're going to talk about business income deductions. Let's hit it. Greetings everybody, and in this class we're going to have two learning objectives. First, we're going to identify common business deductions, and then we're going to determine the limits on deducting business expenses. And so, when thinking about this chapter, again, this is the beginning of phase 3. So phase 1 we talked about individuals. Phase 2 we really kind of concentrated on property transactions, which can affect both individuals and businesses. And now we're really focusing on phase 3, which is where we're talking about more business and corporate transactions. Okay, so the first chapter in this area we're going to look at is going to be individual businesses, sole proprietorship, so to speak. And this is kind of, I would say a lot of the same ground rules that apply for sole proprietors apply for a lot of other places. And you'll see that as we go through with this, and it lays a really good solid foundation before we get into some of the bigger stuff when we talk about corporate transactions, partnerships, and things of that nature. All right. So the number one thing that you see up there is about business income deductions has to be tied directly to the business activity. So places where you will see this can be a little confusing are people who have multiple entities. So for example, I own Beta Solutions. I also have another company called Stoic Investments where we do some other stuff. Most of, when I'm trying to figure out who I'm spending money for, I got to make sure that whatever I'm spending money to ties it specifically to the activity that's involved. Okay. And by the way, it's not just simple individuals who have multiple entities that could be an issue. You could also have partnerships that are multi-activity partnerships that could have this as a problem. Corporations, usually this isn't a major issue unless you're talking about like consolidated statements, but generally it's a little bit more advanced accounting, so we're not as worried about that, but definitely got to make sure that it's correct to the business activity in mind. And when we're looking at this, there's that bullet point 2 basically lifts right out of Code Section 162, which basically says that all business deductions have to be ordinary and necessary. So, for example, running a CPA firm, one of the most common expenses that we have in CPA firm land is paper. Okay, so as we run our business, as we do our work and we build certain things up, we spend a lot of money on paper. Okay, other businesses might not have as much need for paper as we do. So if the IRS comes in and they see that, I'm buying, $10,000 worth of paper, that may not be that unusual given the fact that I'm a CPA firm. Small, computer IT shop, $10,000 worth of paper might be a little, hey, what's going on here? All right, so necessary, an example for the CPA firm. So if I were to go out and buy a brand new sports car, I don't really need that in order to be able to do my business. And so, when you're going out and you're buying things that are particularly in the area of extravagance, they talk about that in that second sub point. If I have to buy a car because we're going to be driving to clients as we do our audits, I can justify that in a business. I can justify buying an SUV. I can justify buying, a comfortable car. I can justify buying a whole lot of stuff. An Aston Martin. And now the IRS is probably going to say, okay, you're kind of getting a little off the rails here. Okay. Now there's another thing that I want to talk about, and it's not on those slides, but I think it's very important. With business expenditures, you're going to have basically two different categories. Okay, it's a little bit above and beyond the course, but I think that I wish somebody had told me this when I was taking taxes, because nobody ever did. But the way the IRS kind of looks at it is that there's general substantiation and then there's specific substantiation. And so what they mean by that is, and this kind of gets into sort of the practicality of taxation, I'd say, where the IRS sees the most abuse are areas of travel, areas of meals, and areas of mileage. Okay, and so those are going to fall under what's called specific substantiation. In other words, when I say that I drove 100 miles in order to accomplish Project X, I've got to justify to the IRS that 100 miles was legitimately for business. I got to tell them where I went, what was the purpose of the visit, how far I went, maybe even document some proof that I was up there. Okay, so they're gonna drill down in the details when they start looking at those types of expenses. Now, general substantiation is a little less involved. So, for example, paper. The IRS is not going to come in and justify every single sheet of paper that I buy and make sure that it's done for the business. Now, that doesn't necessarily give you a carte blanche to say, okay, well, I'm going to go ahead and I'm going to buy a whole bunch of office paper for my business and I'm going to take a couple reams home so that I can use it in my own house. That's violation of ethics, okay? And so, but are they going to come back and say, you bought 6,000 sheets of paper, prove to me all 6,000 sheets was for that? That's impractical. So you're not going to see them do stuff like that. But, given that, and the reason why I kind of bring that up is because it really gets into the heart of record keeping. I've always said, and what I'm about to say is I've said it to some CPAs and they thought it was very controversial. Taxation's about the story you tell. Okay, when I say story you tell, I don't mean lying. No, we don't lie. But how things fit in depends on what the background is. So, and then the second thing is what we can do and get away with for our clients or help our clients get away with depends solely upon how we document our actions. Okay, so if your client keeps really good records, or you keep really good records for your client and they bill you for it, that's going to be really good for you if you ever go to an audit where you can say, okay, here it is, bam, 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 bam. It's always nice to walk into an audit, especially an office audit, and say, here's a list of all my expenses. Here's a list of all the receipts. Here's a copy of all the receipts stapled to this that attached to this sheet because these receipts belong to this sheet. Very, very organized. You walk in there like that, you've won 80% of the battle. Because the IRS is going to look at it and they're going to say, okay, this guy knows what he's doing. They kept good records. I'm going to verify this. But if everything looks good, we'll probably close the case. If you walk in there and you say, okay, you want us to justify $6,000 of expense, yeah, and you sit down, put your feet up on the desk, and you say, okay, $6,000, here's what he spent it on, blah, 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 blah. Where's your documentation? Don't have it. How do I know that you actually spent this? Can't prove it. Okay, the IRS is going to deny it, and then the IRS is going to say, hey, if they're this messed up on this transaction, maybe they're messed up on more. And so that's where it kind of you got to really understand that as you get into this, you got to do good documentation and record keeping. And so if you do work in the tax area and you notice that your people are being a little bit snippy about making sure that documentation is done right, that might be part of the reason why. All right, so reasonableness. This is a good example where, Rick hires his brother on a part-time basis. I'll let you read it and kind of understand why. But the thing is that what's happening here is that Rick is kind of padding his salary so that he can give him some extra money for college. That doesn't really work out. Now, I don't really like this example because, how do I say this, not getting into trouble? I don't know if the IRS is even going to look at this. An example where they're going to talk about reasonableness. And by the way, I've seen this happen before. You have a client who is, an investor, and this is their whole job. They go around and they do all this investing and they're doing all that stuff. They go to these conferences. Okay. When they're at these conferences, we're talking Las Vegas, we're talking Washington, D.C., New York, expensive places. And these guys are traveling and they're spending buku bucks. trying to wine and dine, shake hands, kiss babies, get everything done in order to be able to make money. Okay. That's where you're going to start getting into this extravagance. Person stays at a hotel and they're staying in a king size suite that's well above and beyond what's necessary in order to be able to accomplish their goals. Okay. Now, that doesn't necessarily mean you can't do an upgraded room. I mean, I've stayed at Marriott where you've got the base level room. And because I'm traveling and I'm going to have to do work while I'm doing that, well, I want the room that's got the good desk in order for me to be able to do this and do this comfortably. Okay. That's not unreasonableness. Unreasonableness is me going to them saying, I need the presidential suite, because I need it. Okay, so that's and again, a lot of that's going to be facts and circumstance, and again, it's going to be dependent upon the story that you're able to tell as a result of that. Now, there are some statutory limits on business expenses. So, for example, where we talk about expenditures against public policy, that's where you've got no deductions for fines, bribes, lobbying, political contributions. Most of that kind of makes sense. Now, I've had people who have tried to justify lobbying and political contribution expenses before. Not so much the political contribution, but the lobbying. The problem is lobbying is a well-regulated activity. And not only is it well-regulated on the business side, it's also well-regulated on the politician side. And so what they're saying is that, look, we're not going to give you a tax break because you're up schmoozing with Congress people or their staffers trying to get your favorable situation in. Yeah, you could justify that it's ordinary and necessary to your business, but we're just going to say, look, that's not good for governance. And so we're not going to allow you to have a deduction for it. Expenses related to tax exempt income you don't see tax exempt income that often in business. Saw a lot of it during the COVID thing because of the PPP loans, which is the payroll protection plan loans, where they basically said, look, we're going to give you a whole bunch of money if you spend it the way that we want you to spend it. The way we gave it to you is a loan, but if you spend it like we want you to, we're going to write off the loan. It'll be tax-free income to you. Okay. And on top of it, you can take all the deductions. Wow, it was really a good deal. Okay. And that's where they did a statutory exception to the statutory exemption, where they said, hey, because in the past, like it says, if you have proceeds that are tied to that, and we're saying, look, I'll give you a clear-cut example. You have a small business and they said, PPP loan, we're going to give you $500,000. Spend it on employee expenses and rent. Okay, because that's pretty much what they allowed you to spend it on. And if I tell the PPP people, say that 5 times fast, hey, I spent, $500,000. I spent all this like you told me to on payroll and on rent. Well, under this rule, you're not supposed to take a tax deduction for it. Now, they did, and they actually changed the law in order to accept it on this one, because they were like, okay, companies are kind of suffering enough. Let's go ahead and give them the deductions. That said, however, most of the time you won't see it, and in very common times that you'll see it, and it doesn't always apply in business also, it also applies in individuals, that if you have any expenses that are related to the development of tax-exempt income, so if you have advisory fees, or if you have margin interest or loan interest for buying things that relate to tax-exempt income, this isn't as much of a big deal as it used to be. When I first started in the industry, advisor fees were tax deductible. So what you would have to do is you'd say, okay, this person spent $30,000 on tax advisor, not tax advisor, but wealth advisor fees, because maybe it's a $5 million client, and of that $30,000, we're going to say this much attributes to the tax exempt income. So that's how that ends up happening. You also have capital expenditure. We're going to go a little bit more into detail in some of these other slides, but I'm just kind of giving you some examples as they are, and we'll kind of talk about that. Okay, so capital expenditure. What does that mean? So if you have something that provides future benefits. So, for example, I go out and I buy prepaid insurance, or I buy annual insurance. My insurance that I buy for this building here, I pay an annual policy. Okay. Now, because of the 12-month rule that they said, even though I'm technically supposed to go ahead and capitalize it, I don't have to. Okay, because you can deduct if the benefits are less than 12 months, and the benefits do not extend beyond the past of the next tax year. Okay, so even if I have, say for example, I have something where I could pay it off within 12 months, but the benefit goes for the next 24 after that, then I'm going to have to capitalize. Okay. It does not apply to interest expense, and it's difficult to apply for accrued taxpayers. Yeah, accrued taxpayers, most likely they're doing this anyways, and so they're not going to necessarily expense it immediately anyhow. 12-month rule example, Ben's a cash basis taxpayer, makes the following payments on June 30th of this year. $10,000 for the next 10 months of utilities, $12,000 for insurance over the next 24 months, $9,600 for the next 8 months of interest. Go ahead and hit pause and make up your answer. And so this is the answer. I hope you got it right. And if you didn't, go back, reread what I said about what the 12-month rule is, and then come back and try to get that figured out. All right, business expense with personal. Okay, so no business deduction for purely personal expense. I mean, I don't think that should rile any feathers by anybody watching this. So if I take a trip to Hawaii and I run it on the company credit card, can I take it as a deduction? Obviously not. Okay, now where this gets interesting, you will have purely personal. You will have purely business. And where we get into trouble is the in-between. Okay, so for example, a travel that I do or used to do, I didn't do it last year, unfortunately, because we were busy. But a typical trip that I would do is I always attend the CPA Connect conference, because that's where us small CPA business owners get together, hobnob, come up with ideas, attend some CPE so we can get the CPE credits. We're meeting with friends that we're talking to by email all year long, but we're actually putting names to face, shaking hands, kissing babies, drinking great drinks, and having fun. Okay? But it's purely business. Okay? Yeah, these are friends of mine, but they're friends in business. Okay, these are not the person. I mean, something happens to me, they're not coming to my funeral. Okay, they're business associates. Okay, that said, running on the credit card, company credit card, and going to Hawaii to go hang out with my wife and my son, that's a purely personal business trip. Now, I'll give you an example of something that I have, because past Ashley, they can't come after me for it anyways. Not that I did anything wrong, didn't do anything wrong. I just don't want the IRS to be like, oh, really? We need to examine that. In 2017, I went to go visit my half-sister while I was on a business trip. Now, the way it worked out, I was at the business trip, because this is one of those CPA Connect conferences, happened to be in the same city she was. Okay. And so I said, okay, fine. So I went out there, and I was there for, I want to say it was about 2 weeks. I went out there for the conference, and then afterwards I attended another conference that was located nearby. And so in between those two conferences, I drove for like a quick day, headed up, had dinner with her, and then went back to the hotel room. Okay. I did not go to Denver to go hang out with her, but I did have a day where I spent with her. So the way this gets done, the way I did it on my returns, is I said, look, for a 2-week trip, we're going to apportion some of that to personal use and not take it as a tax deduction. Okay, you have to keep good record keeping. Again, travel is a specific substantiation. So who did I go see? Why was I doing this? How far did I go? You got to answer the 5 W's. Okay, who, what, when, where, why, and how. General substantiation, probably not as much. Okay, you could you could do. They say allocate. Arbitrarily. I think it gets you into trouble. I always say do it by days. And if you're like, well, I only spent like 3 hours with them. Again, I would probably talk to your partners about how they want this done, but some partners might go, look, if the guy was there for a week and he spent 2 hours hanging out with some family, I'm not going to change this. Okay. That's not significant. And I don't think the IRS would make a big fuss about that either. Where they're going to make a big fuss is I go there for 2 days for this conference, and then I spend 2 weeks hanging out with my family. That's mostly personal, and you're going to have to write a lot of that trip off. Okay. So here's an example. I'm not going to get too much into it because we're getting kind of long on the video anyways. But basically what ends up happening is that, if you spend 2 days in the business meeting, if you spend 1 day in the business meeting, and then what amount are deductible if they're provided by the restaurant, it's not as, provided by the restaurant actually was an issue in 21. I think that's just wording that they forgot to take off. So don't bend yourself in a pretzel the wrong way by the restaurant issue. Because what ended up happening is that post-COVID, they basically said, look, all the restaurants are suffering. We want people to go out and have business lunches again and business dinners and hang out and do stuff. So they elevated, because meals are normally 50% deductible. Because, let's be honest, if you're not doing business, you're still going to eat, right? But in order to cover the potential additional cost that's going to have to happen in order to discuss business, they said, well, we'll let you take half. Okay. In order to encourage people to go out and start having business lunches again, they said, look, for 20 and 21, we're going to go ahead and let you take 100% deduction on that. It's a great deal, actually. I also like buying stuff for my employees here. That was always a good deal. So this is kind of their answer. I'll let you read that and kind of figure that out on your own. Business interest limit. Okay, so if you have a company that has average gross receipts of less than 29 million, you don't have to worry about this. But if it's over 29 million, you're going to have to calculate this, and this could show up on the test. Okay, where you got the business interest deduction. It's going to be limited to that business interest income plus 30% of adjusted taxable income. Okay. And then you've got some adjustments that you have to do here. I'll be honest, I don't have any clients that deal with this, so I'm not really probably the smartest person on that. But again, the way I've talked to students in the past, practice about 3 or 4 problems, you'll have it licked down. It's not a big deal. Okay, so this is the example that they came up with on that. Now, sale of business assets, we really talked about this in Chapter 11, where we said, look, losses are going to be deductible if they're recognized. Losses on sales to related parties are not deductible by the seller. So you can't sell it to somebody else for a loss and then say, okay, I want to take the loss now. That's not how that works. Casualty losses, just a little FYI, these are starting to go away. For many, many years, this was a big deal. And I remember this used to be a big testable item on the CPA exam. They may still test it, but I'm anticipating that by 2026, this may be gone. Or they're going to do basis reduction and that's it. I don't think they're going to let people take tax deductions. I know it doesn't happen on the individual side, but if you have a business related casualty loss, there is a deduction that you can take on that. Okay. And that's how they're going to do with that. All right, folks, so that's the end of this video. I want to say thank you very much for watching it. And if you have any questions, feel free to reach out to me to talk about this. And, guys, keep it moving forward. We're in business transactions. It means we're only have a third of the class left. And then you're going to get out of here. You're going to get that nice grade and move on. I want to say thank you very much for watching this video. And I look forward to seeing you guys in class.